There's a lot of confusion about the treatment of working capital when selling a business. Working capital features in business valuations, in the sale price allocations, and also in sale adjustment calculations, to name just a few. Most business owners and even some advisors don't understand how working capital can impact on the goodwill of a business and how it is accounted for in the context of a business sale. The consequences of not knowing can be dramatic, with owners giving away substantial value without even realising it. The topic is too broad and too complex to cover in a single video, so we've broken it into a series of 3 videos so each aspect can be properly explained. This is video 1 of a series of 3 videos, specifically on working capital in the context of a business sale transaction. The aim being to clear up any misconceptions and explain how optimising working capital can benefit the existing owner. In this video we explain what is working capital and what is included in it. What is the significance of working capital when selling a business? What is the working capital requirement of a business? Working capital in the context of running a business versus in the context of selling a business. Is it better to have more or less working capital? And how can you reduce working capital? In another video, we'll discuss how working capital is accounted for during a sale process. Are working capital assets and liabilities sold when a business is sold? When is working capital included in the sale and when it is excluded, and why? What are the differences in treatment when company assets are sold versus company shares? Why the need for a working capital adjustment? How do you account for differences between the working capital requirement and the actual working capital at completion? How working capital is treated in a locked box transaction, and why and how you would adjust for changes in working capital in a sale transaction. And in a 3rd video, we'll cover the key working capital elements to see how each can be accounted for, being inventory, including stock in transit, trade debtors, trade creditors, cash, and employee entitlements. I hope you enjoy the series. And now for part 1. So firstly, what is working capital? Working capital is the name given to a group of current assets and liabilities that are required for the day-to-day trading operations of a business. They are constantly turning over and converting from one category to another, generally to and from cash. Working capital assets and liabilities are also considered sources and applications of funds. The working capital assets are considered applications of working capital funds, while the liabilities are considered sources of working capital funds. The components of working capital vary from business to business, but will generally include, on the liabilities side, trade creditors and other creditors and accruals, accrued employee entitlements and other liabilities. Depending on the country, often goods and services tax net liability, and customer deposits received. And on the asset side, inventory, being stock on hand, raw materials, finished goods, work in progress, and stock in transit. Trade debtors and other debtors and prepayments. Deposits paid. And very importantly, cash. We'll discuss each of these critical components in more detail in another video. Next question, what is the significance of working capital when selling a business? Well, there are several aspects to this question. Firstly, let's touch on how working capital features when valuing a business. Working capital is part of a business value or enterprise value. No credible business valuation can be performed without considering and including working capital. We'll elaborate on that in another video. However, to explain briefly, working capital assets and liabilities are components of the overall assets and liabilities required to generate the profit in a business. They therefore form part of the overall enterprise value, just as plant and equipment does. Let's look at the working capital requirement. The amount of net working capital deemed to be required in a business is called the working capital requirement. So how do you calculate the working capital requirement in a business? Although many people may take a shortcut and adopt the closing month-end or year-end values, this may distort the position and may turn out to be unfavourable for the seller. A more accurate way is to map out the daily balances for the key components over the 1 or 2 most recent years. Debtors often peak at the end of a month, where there could be up to 2 months of debtors on hand. And even though that's only for a few days, if it's recorded at the end of month, then you're going to show an unusually high trade debtors amount compared with what it would be during the month and building to the end of the month. So the best and fairest way overall for both parties is to run daily balances, exporting them from the accounting package, usually from the detailed general ledger, into Excel, and then using the formula to select the last balance on each day and chart these for analysis. We'll put on the screen now an example of what a chart looks like when you've done this exercise. Is it better to have more or less working capital in a business? Well, it depends on the context. If you're talking about the ongoing operation of a business, the answer might be 1. But if you're talking specifically in the context of a sale, you might have a different answer. So firstly, let's look at working capital when running a business. Well-run businesses constantly strive to keep their net working capital to a minimum, to make their money work harder for them and generally achieve a higher return on funds employed. However, many more business owners don't worry about how much of their investment is tied up in working capital, and it can often grow without anyone being sensitive to it. Most owners or managers operating a business will be striving to maximise the profit, and driving sales and margins are a great way to do this. These drivers encourage holding adequate stock levels and buying it at the best prices. So buying in bulk and the most economical way may require holding more stock than is absolutely necessary. Inventory is a key working capital item. Also, giving customers some flexibility on trading terms enhances sales and customer relationships, both conducive to growth. Of course, they result in increasing the trade debtors balance. And even paying your suppliers or your creditors early or definitely on time also allows the business to achieve a higher standing with key suppliers, who may then look after the business ahead of others. All these factors tend to increase the net working capital while driving up profit, of course. So that covers working capital in the context of running the business. Now let's look at working capital in the context of selling a business. The dynamics of working capital change completely when the business owner changes from run the business mode to sell the business mode, and someone explains how businesses are valued. Whereas working capital has been not necessarily as sensitive in a business, when the valuation focus arises, the amount of net working capital takes on a whole new level of sensitivity, and owners realise how productive it can be to reduce their investment in net working capital. We'll elaborate on business valuation methodology in other videos. But put simply, the enterprise value of a business on a going concern basis includes all those assets and liabilities required to generate the profit, which include the working capital items. Once that specific value or value range has been arrived at, then the various components that comprise it can be analysed. For a given enterprise value, the higher the net working capital component thereof, the lower will be the goodwill component. So the more you have tied up in working capital in your business, the lower will be the goodwill component. And conversely, the lower the net working capital requirement, the higher the goodwill component in the overall enterprise value. So from that you should see that, generally speaking, in the context of a sale, the aim would be to try and reduce the net working capital requirement in a business. Depending on your industry and business model, it may be easy or hard to lower your net working capital requirement. So for example, importing distribution businesses seem to have a battle to keep stocks low because of the longer lead times, for example, of importing. If they can buy from a local wholesaler who carries the stock, then this releases working capital, turns it into cash, which you can then take from the business when you sell it. The amount of working capital can also be reduced by tightening up on slow payers to rein in trade debtors. and also stretching out trade creditors, so by not paying them earlier than you need to. So clearly, as balance sheets do become bloated, it increases the working capital component and decreases the goodwill. So now you have an introduction to working capital, what it comprises and how it's calculated and how it can impact on the overall sale value. We look forward to bringing you videos 2 and 3 shortly.